Welcome to The Explainer. Today, we're jumping right into a really fascinating scientific deep dive into the performance of a specific automated trading strategy. We're looking at a bot, an expert advisor known as the DAX40 two-state regime 6, which was unleashed on the DAX40 index. Now, I know looking at algorithmic testing reports can sometimes feel like you're just staring at the matrix, right? But I promise you, these numbers tell an absolutely thrilling story about risk, mathematical paradoxes, and ruthless mechanical execution. So we're going to decode this whole thing together, step by step, using the raw data straight from the strategy tester report. Okay, let's dive into this. To keep things snappy, we've organized our analysis into 6 quick segments: the setup, headline profit results, the win rate paradox, analyzing the drawdown risk, timing and trade behavior, and finally, the final verdict. Section 1. The setup. Laying the algorithmic groundwork. So establishing our baseline here is absolutely crucial so we know what we're dealing with. This bot was deployed on the GR40, which tracks the top 40 blue chip companies in Germany. It operated on a 1-hour chart timeframe, that's H1, and it ran through the first half of 2026, specifically January 1st to July 9th. We're looking at a hypothetical starting deposit of 50,000 US dollars, using a leverage of 1 to 100. Basically, that means we've got a moderately capitalized account with some pretty significant buying power. Okay, so that's our arena. Let's see how the bot actually performed in it. Section 2. Headline profit results. The bottom line numbers. Let's get right to what everyone wants to know first. Did it make money? The answer is a massive yes. The total net profit came in at an incredible $19,217.31. To put that into perspective, that is nearly a 38% return on that 50K deposit in just over 6 months. And honestly, what's really crazy here is that this profit was generated over a pretty small sample size of just 121 total trades. But, a single isolated number doesn't tell us how bumpy the actual ride was. And this brilliantly illustrates the journey of that capital. Looking at the balance and equity curve, you can see a clear, sustained upward trajectory. This is a vital piece of the puzzle because it proves that 19 grand in profit wasn't just some lucky lottery ticket trade at the very end of the test. Not at all. It's a grinding, climbing curve over the entire testing period. Sure, there are plateaus and there are dips, but the algorithm just consistently ground its way up to higher highs. Section 3. The win rate paradox. Challenging conventional trading logic. All right, get ready for a plot twist. Out of those 121 total trades the bot took, it actually lost 84 of them. I mean, the contrast here is just shocking. This strategy has an abysmal 30.58% win rate. It is literally wrong nearly 70% of the time it touches the market. Think about that for a second. For a human trader, being wrong 7 out of 10 times, that's incredibly demoralizing. Most people would just pull the plug on this machine after the first couple of weeks. Which brings us to arguably the most compelling question of this entire explainer. How in the world does an algorithm lose 70% of the time and still manage to crank out a 38% net return, resulting in over $19,000 in profit? So the crucial point is the sheer asymmetry of the trade outcomes. The mathematical secret weapon of this bot is that it cuts its losses ruthlessly. When it's wrong, it takes an average hit of just about $476. But when it's right, which again is only about 3 times out of 10, it lets those winners run, locking in an average profit of over $1,600. The winners are literally more than 3 times the size of the losers. It's essentially a classic trend-following breakout philosophy, perfectly executed by a cold calculating machine. Fail small, win big. It mathematically overrides that terrible 70% failure rate entirely. Section 4. Analyzing the drawdown risk. The psychological cost of doing business. Now, high returns always come with a price tag, right? The report shows a maximal equity drawdown of 14.05%. In plain dollar terms, that translates to a peak-to-trough drop of over $10,100. What that means is, at its absolute worst moment during this 6-month stretch, that $50,000 account, plus whatever profits it had accumulated, was floating a terrifying $10,000 loss. That is the true risk of the system. That is the price of admission you have to pay to reach that final $19,000 finish line. Let's break down the actual psychological pain required to trade this thing in real time. Check out these consecutive streaks. At one point, this bot suffered 10 consecutive losses in a row, bleeding out nearly $4,000. Meanwhile, its maximum winning streak was only 3 trades. On average, you're losing 4 times in a row before you ever see a winner. As a user, you'd have to sit on your hands, watch your account get dinged 10 times back to back, and just trust the math enough not to interfere. A robot does this flawlessly without breaking a sweat. A human manager, yeah, they usually panic.
Section 5. Timing and Trade Behavior. Inside the machine's mind.
Now, what's really interesting about this breakdown of market activity is exactly when the bot decides to strike. It has a massive preference for trading on Mondays and Thursdays. Tuesdays, Wednesdays, and Fridays, pretty quiet. Because of that, Mondays and Wednesdays show these huge spikes in gross profits. Also, the bot heavily favors the European morning hours. It's specifically hunting for those initial bursts of market volatility right when the German index opens up for the day. To add to that, the average position holding time is just over 6 hours. This tells us the DAX40 two-state regime 6 bot is strictly an intraday strategy. It jumps in during those volatile morning hours, hunts for that asymmetric payout we talked about, and then almost always closes out its risk within the exact same trading session. It rarely holds positions overnight, which is great because it completely shields the account from those nasty, unpredictable gap openings the next morning. Section 6. The final verdict. Let's move to and see how this builds into grading the algorithm's overall efficiency. These efficiency scores are seriously impressive. A profit factor of 1.48 means that for every single dollar the system lost, it generated $1.48 in profit. That is a fantastic edge to have over 121 trades. A recovery factor of 1.90 shows it easily earns back those scary drawdowns we looked at earlier. But the absolute crown jewel here, that Sharpe ratio of 3.95. For context, the Sharpe ratio measures risk-adjusted performance, and a score pushing 4.0 is just phenomenal. It indicates that the returns it's generating are exceptionally high compared to the wild volatility and risk the algorithm is taking on.
But I want to leave you with a provocative final thought here. The numbers are brilliant, right? The math is completely sound. But the daily mechanics are just brutal. You've got a system with a phenomenal Sharpe ratio and a massive net profit, but it literally requires you to be wrong 70% of the time. So my question to you is, if you were managing this algorithm, could you actually stomach 10 consecutive losses and an agonizing $10,000 drawdown just to let the machine do its job and deliver that 38% return? It's a fascinating look at the massive divide between algorithmic perfection and human psychology. Thanks so much for joining me on this explainer, and as always, keep learning.